You were told that debt was freedom. You were told that credit builds opportunity. You were told that the system rewards participation. But if it rewards participation, why does participation feel like dependency? Why does progress often look like deeper obligation? If the system is neutral, why does it seem to tighten precisely when you begin to rely on it? They did not design it to collapse on you. They designed it to hold you in place. Not through force, through structure. This is not about personal failure or irresponsible decisions. It is not about spending habits or budgeting mistakes. It is about the architecture of modern credit economies and how that architecture aligns incentives. It prioritizes institutional stability over individual autonomy. The trap is not dramatic. It is procedural. It begins with access. Access to credit cards, auto loans, student debt, mortgages. Access feels like expansion. It increases purchasing power immediately. It smooths consumption over time. It creates the appearance of upward movement, but access is not ownership. It is conditional leverage. Leverage connects you to a system whose survival depends on your continued participation. Modern economies are structured around debt expansion. Growth is measured in credit creation. When banks extend loans, new money enters circulation. When debt contracts, liquidity tightens. Economic growth, in many advanced economies, has become inseparable from rising household and corporate debt. This creates a quiet dependency. If debt growth slows, consumption slows. If consumption slows, corporate revenue weakens. If revenue weakens, employment adjusts. Employment instability increases default risk. Default risk triggers credit tightening. Credit tightening further slows growth. The cycle is circular. Participation sustains it. At first glance, this appears mutually beneficial. You receive access. Institutions receive interest income. The economy expands, but the symmetry is incomplete. Banks operate with access to central bank liquidity, capital buffers, and regulatory frameworks, designed to preserve their solvency. Individuals operate with income volatility, rising living costs, and limited bargaining power. When stress emerges, the system absorbs volatility asymmetrically. Consider credit scoring. Credit scores are presented as objective measures of responsibility. They are treated as reflections of character. In reality, they are predictive risk tools, designed to estimate probability of repayment under varying economic conditions. They reward consistent debt usage and penalize inactivity in certain contexts. Having no debt history can lower a score. Carrying small balances may improve it. Closing long-standing accounts can reduce it. The paradox is subtle. You are encouraged to borrow in order to demonstrate trustworthiness. Trustworthiness then determines the price of future borrowing. Borrowing becomes both test and solution. If you opt out entirely, your profile weakens. The system prefers engagement. Engagement generates data. Data fuels algorithms. Algorithms determine access. Access ensures continued participation. The trap does not require coercion. It requires alignment. Minimum payments illustrate this alignment clearly. They are marketed as safety nets, mechanisms that prevent delinquency. Technically, they serve that function. But minimum payments are calculated to extend debt duration significantly. By paying only the minimum, the borrower avoids default while maximizing interest revenue over time. The account remains active. Interest compounds daily. The principal declines slowly. From the institution's perspective, this is ideal. From the borrower's perspective, it feels manageable. Manageability replaces urgency. Urgency would disrupt predictability. Predictability stabilizes securitization markets. Credit card receivables are bundled into securities sold to investors. Those investors rely on projected cash flows derived from millions of minimum payments arriving on schedule. Your payment behavior contributes to global capital markets. The connection is indirect but structural. If large numbers of consumers accelerate repayment, securitized yields decline. If they slow repayment excessively, default risk rises. The system seeks equilibrium. Equilibrium requires you to revolve debt, not eliminate it too quickly, not default abruptly. Balance is profitable. Balance is dependency. Interest rates adjust in cycles. When central banks raise rates to manage inflation or currency pressure, variable rate debt reprices quickly. Credit card APRs increase. Adjustable mortgages reset. The cost of maintaining debt rises. The increase often occurs gradually enough to avoid immediate shock. But gradually does not mean harmless. Rising interest consumes disposable income. Disposable income supports consumption. Consumption supports corporate earnings. Corporate earnings sustain asset prices. Asset prices support pension funds and institutional portfolios. The system interlocks. You may believe your loan is isolated. It is not. Housing offers another example. Mortgages extend over decades. During expansion phases, rising home prices create equity. Equity can be borrowed against. Borrowing stimulates further consumption. The home becomes both shelter and collateral. Collateral supports leverage. Leverage supports growth. When prices stall or decline, equity evaporates. The borrower remains. The institution reclaims collateral, if necessary. Loss is redistributed. The illusion of safety fades slowly. Student debt illustrates structural asymmetry even more starkly. Education is framed as investment in human capital. Loans finance that investment. Repayment depends on future income. If income disappoints, the debt remains. In many jurisdictions, student debt is difficult to discharge in bankruptcy. The obligation persists across economic cycles. Institutions receive guaranteed payment streams or government backing. The individual carries uncertainty. The trap is not accidental. It reflects prioritization of credit stability over borrower flexibility. Corporate debt follows similar patterns. Companies borrow to finance expansion, share buybacks, acquisitions. Low interest rates encourage leverage. Share prices rise. Executives are compensated in stock. If revenue declines, layoffs occur to preserve margins. Workers lose income. Corporations refinance or restructure. Access to capital markets differs dramatically from access to household relief. Institutional asymmetry widens quietly. This asymmetry is rarely presented as design. It is described as market efficiency. Efficiency reduces friction. Reduced friction increases participation. Participation fuels growth. Growth sustains confidence. Confidence masks fragility. Fragility accumulates slowly. When stress events occur, such as financial crises, central banks inject liquidity into markets. They purchase assets, lower rates, extend swap lines. Liquidity supports institutions first. Support eventually filters outward, but the sequence matters. Institutions receive stabilization rapidly. Households receive indirect relief gradually. The difference reinforces hierarchy. Hierarchy defines who is protected. Protected systems endure. Unprotected participants absorb volatility. Over time, debt burdens accumulate relative to income growth. Wages often lag asset inflation. Housing, education, healthcare costs rise. Credit fills the gap. Credit normalizes imbalance. Normalization reduces alarm. Alarm would trigger adjustment. Adjustment would slow growth. Slowing growth threatens leverage. Leverage is foundational. The design does not require malicious intent. It requires structural incentives aligned toward perpetual expansion. Perpetual expansion in finite systems introduces tension. Tension is managed through policy, refinancing, restructuring, rarely through elimination. The mechanism gap begins to close here. The trap is not a cage. It is a loop. Debt generates money supply. Money supply sustains asset prices. Asset prices justify further debt. Further debt expands money supply. Breaking the loop contracts liquidity. Contraction reveals fragility. Fragility threatens stability. Stability is preserved through intervention. Intervention sustains the loop. The consequence gap emerges. What happens if growth slows structurally? Debt burdens become heavier relative to income. Servicing costs crowd out discretionary spending. Defaults rise incrementally. Institutions tighten standards. Access narrows. Those already leveraged struggle most. The adjustment does not look like sudden collapse. It looks like stagnation. Stagnation feels personal. It is systemic. Historically, debt cycles span decades. In the late 19th century, railroad expansion was financed by extensive leverage. Overextension led to panics. Credit contracted. Consolidation followed. In the 1920s, consumer credit expanded rapidly in the United States. The Great Depression revealed how fragile leveraged consumption could be. Post-war expansion rebuilt trust through regulation and deposit insurance. Over time, regulation softened. Innovation increased. Shadow banking expanded. Complexity deepened. The core pattern persisted. Growth financed by leverage. Stability maintained by confidence. Confidence reinforced by rising asset values. When asset values stagnate, confidence weakens. Weak confidence prompts caution. Caution reduces lending. Reduced lending slows growth. The loop tightens. You were told that responsible participation builds security. It does, within certain parameters. But security remains conditional. Conditional on employment. Conditional on asset prices. Conditional on monetary policy. Conditional on institutional solvency. Individuals rarely influence these conditions. They experience them. The system was designed to prevent abrupt breakdown. It was not designed to eliminate dependency. Dependency ensures participation. Participation ensures liquidity. Liquidity sustains asset values. Asset values reinforce political and financial stability. Stability is prioritized. Autonomy is secondary. This realization does not require panic. It requires clarity. Credit systems function as engines of expansion and instruments of control simultaneously. They expand opportunity. They constrain exit. Early repayment reduces interest income. Default increases systemic risk. Optimal behavior lies between extremes. That balance favors institutions. Institutions can refinance, restructure, lobby, access central liquidity. Individuals negotiate within contracts. Contracts are enforceable. Enforcement maintains predictability. Predictability sustains securitization. Securitization funds further lending. The architecture is elegant. It is also binding. Binding does not mean hopeless. It means interconnected. Interconnection reduces freedom to disengage without consequence. Opting out of credit can restrict access to housing or business opportunities. Opting in increases obligation. The spectrum is narrow. The final clarity is quiet. They did not design a trap to collapse you instantly. They designed a framework where movement is possible, but always tethered. Tethered to income. Tethered to rates. Tethered to credit scoring. Tethered to asset valuations. The framework persists because it aligns with growth objectives. Growth remains the organizing principle of modern economies. As long as growth depends on debt expansion, participation remains necessary. Participation feels voluntary. Structurally, it is expected, and the realization often arrives late. Not when the first loan is signed, not when the first payment is made, but when limits tighten and options narrow simultaneously. By then, the loop is already internalized. The system continues to operate, calmly, predictably, according to incentives embedded decades ago. The trap is not dramatic, it is structural. And it is maintained not through force, but through design.